Time to level up your investment game. Ready to unlock the real estate game without the landlord life? Buckle up because we're diving into the top 10 real estate investments that could fuel your passive income dreams in 2024. But remember, even though we're dropping some knowledge gems, this isn't financial advice. Always do your own research before investing. Now, what makes REITs so special? They're like owning a chunk of real estate empires, shopping malls, apartments, warehouses, the complete package, but without the hassle of leaky roofs and angry tenants. Plus, they're required to pay out most of their income as dividends, meaning regular rent checks for you. But with 10 options, where do you even start? Don't worry, we got you covered with this diverse crew. 1. Prologis, PLD. The king of logistics warehouses, riding the e-commerce boom like a pro. 2. Realty Income, O. A dividend machine with diverse properties and a rock-solid track record. 3. American Tower, AMT. Cell tower titan, profiting from our insatiable need for data and selfies. 4. The Ventas Company, VTR. Healthcare real estate specialist catering to an aging population. 5. Equinix Inc., EQX. Data center powerhouse, fueling the digital world's insatiable appetite for storage. 6. Public Storage, PSA. Self-storage king capitalizing on our ever-growing love for accumulating stuff. 7. Essential Utilities Inc., EEU. Utility REIT, providing essential services like water and electricity with stable returns. 8. Alexandria Real Estate Equities, Inc., AR. Life science real estate rockstar, investing in labs and research facilities. 9. WP Carey Inc., WPC. Diversified Net Lease REIT, owning everything from industrial buildings to hotels. DES, Digital Realty Trust Inc., DLR. Data center giant, another player in the booming digital infrastructure game. Remember, these are just examples, and every REIT has its own unique risks and rewards. Consider factors like sector focus, dividend yield, management track record, and valuation before making any decisions. Here's what you've been waiting for, the benefits. Here's a breakdown of the potential benefits for each REIT. Medicine Prologis, PLD. High exposure to the booming e-commerce market. Strong track record of dividend growth. Diversified portfolio of logistics warehouses across various industries. 2. Realty Income, O. Exceptional dividend history with over 60 years of consecutive annual increases. Focus on necessity retail properties like drugstores and convenience stores offering relatively stable income. Strong tenant credit quality and long-term leases. 3. American Tower, AMT. Stable and predictable income due to long-term lease agreements with wireless carriers. Limited competition and high barriers to entry in the cell tower market. Growing demand for data and mobile connectivity suggests long-term potential. 4. The Ventas Company, VTR. Exposure to the growing senior living population with rising healthcare needs. Diversified portfolio across various healthcare property types, including senior housing, medical facilities, and research labs. Stable income streams backed by long-term leases with government or private payers. 5. Equinix Company. Critical role in the digital infrastructure backbone, housing essential data centers. High demand for data storage and bandwidth driven by cloud computing and streaming services. Strong growth potential in a rapidly expanding market. 6. Public Storage, PSA. Benefit from the increasing demand for self-storage due to urbanization and lifestyle trends. Recurring and predictable income from long-term leases. Relatively recession-resistant as people tend to downsize possessions but not eliminate them. 7. Essential Utilities Inc., EEU. Provides essential services like water and electricity with stable and predictable demand. Regulated industry with limited competition and low customer churn. Offers lower volatility and defensive characteristics compared to other REITs. 8. Alexandria Real Estate Equities, Inc. ARE, focused on life science real estate, a growing sector driven by biotechnology advancements. Long-term leases with high credit quality tenants in the pharmaceutical and research industries. Potential for high rental growth due to specialized nature of the properties. 9. WP Carey Inc. WPC. Diversified net lease portfolio with exposure to various industries, offering some risk mitigation. Triple net leases where tenants are responsible for most expenses, reducing landlord responsibilities. Long-term lease agreements provide stable and predictable income. DES, Digital Realty Trust Inc., DLR. Another major player in the data center market with significant global reach, strong tenant relationships and diverse portfolio of data centers. High growth potential in the digital infrastructure space. But wait, there's more. This video is just the tip of the iceberg. We also cover some crucial factors to analyze before investing in any REIT. Investment thesis. Target sector. Analyze the specific real estate sector the REIT invests in, e.g., residential, industrial, healthcare, and its current and future potential. Growth potential. Evaluate the REIT's historical and projected growth rates for dividends, property value, and overall earnings. Income strategy. Understand the REIT's dividend payout ratio and strategy for balancing income generation and reinvestment. Financial strength. Debt-to-equity ratio. Assess the REIT's financial leverage and risk profile by analyzing its debt-to-equity ratio. Funds from operations, FFO. Evaluate the REIT's operating cash flow stability and ability to cover its dividend payments. Balance sheet strength. Analyze the REIT's overall financial health and its ability to handle unexpected situations. Management. Track record. Research the management team's experience and success in the real estate industry. Compensation. Structure. Analyze the management's compensation structure and alignment with shareholder interests. Transparency. Evaluate the REIT's communication and transparency in financial reporting and shareholder updates. Valuation. Price to earnings, PE, ratio. Compare the REIT's PE ratio to its peers and consider its historical valuations. Price to funds from operations, PFFO, ratio. Analyze the REIT's valuation relative to its operating cash flow. Dividend yield. Compare the REIT's dividend yield to its historical levels and other income-generating options. Additional factors. Lease structure. Analyze the types of leases the REIT uses, e.g., net lease, gross lease, and their impact on profitability and risk. Tenant quality. Evaluate the creditworthiness and stability of the REIT's tenants to assess potential rent defaults. Market risk. Consider the economic and regulatory risks associated with the specific markets and property types the REIT invests in. While REITs offer attractive possibilities, here are some common pitfalls to avoid before diving in. Lack of diversification. Don't put all your eggs in one basket. Invest in a variety of REITs across different sectors, e.g., residential, industrial, healthcare, and geographic locations to spread risk and reduce volatility. Focusing solely on high yields. While attractive, don't chase excessively high dividend yields that might be unsustainable due to high debt levels or poor financial health. Choose REITs with a balance between yield and long-term growth potential. Ignoring underlying property performance. Don't solely rely on historical performance. Analyze the quality of the REIT's properties, occupancy rates, lease terms, and potential for rent increases to gauge future income stability. Overlooking fees and expenses. Understand the various fees associated with investing in REITs, e.g., management fees, transaction fees, and how they impact your overall return. Choose low-cost options like REIT ETFs if fees are a concern. Neglecting liquidity. Remember that some REITs, particularly non-listed ones, might be less liquid than publicly traded stocks. Consider your investment timeline and ability to handle potentially longer sell times. Misunderstanding tax implications. Research how various REIT distributions are taxed and how they might affect your overall tax liability. Consult a tax advisor for personalized guidance. Emotional investing. Avoid making investment decisions based on emotions like fear or greed. Stick to your research, investment plan, and don't panic sell during market downturns. Investing without considering your goals. Align your REIT investments with your overall financial goals and risk tolerance. Don't chase trendy sectors or high returns that don't align with your investment horizon or risk appetite. Failing to do your own research. Don't blindly rely on recommendations or financial media alone. Take the time to understand the specific REITs you're considering, their financials and market trends before investing. Being overly confident. The market is dynamic, and even well-researched investments can perform unexpectedly. Stay informed, adapt your strategy when needed, and avoid overconfidence in any single asset class. No matter where you are on your investment journey, remember, knowledge is power and research is key. Hit that subscribe button for more financial wisdom, and let's build wealth together.